Have you ever been in a situation where you are super confident about stock's up move? Whatever you have tracked is aligning. The support, the resistance, indicators, and even the quarterly results. Your research tells you that in a coming few days, the stock can go up by 15 to 20%. Everything is good except one thing. You do not have enough capital to back your conviction. In situations like these, you can use broker's MTF, that is margin trading facility, wherein you bring some money and other half of the money is provided to you by your broker. For example, you bring 20,000, your broker provides you 80,000, and now instead of 20,000, you can trade the quantities worth 1 lakh rupees. Sounds tempting, right? But before you jump into MTF, you need to understand how it works, what are the risks involved, and should you actually use it. MTF is like a loan from your broker. Instead of paying 100% upfront, you're only supposed to pay a margin of, let's say, 20 to 25%. But in exchange, you have to pay interest on that borrowed amount from your broker. Let's understand with the help of an example. Let's say you want to invest in Reliance stock 100 quantities at 2,500 each, which means it is going to cost you 2,50,000. But your broker tells you, hey, give me 20% margin, which means you invest 50,000. Rest of the 2 lakh is given to you by your broker, on which the interest will be charged. The amount of interest varies from broker to broker, and you can check that on their website. But in this example, we'll take one such broker whose interest rate is 0.04%. So when we continue our example, on 2 lakh rupees, the 0.04 interest gives 80 rupees interest cost for a day, 2,400 for a month, and 14,400 for 6 months. Which means the longer you hold, the higher interest you have to pay. Now you must be wondering, do you actually have to pay 20 to 25% of margin for all the stocks? Well, MTF leverage is different for different stock. It can be 20 to 25% for large caps like HDFC, Infosys, and it can be higher, like 40% for stocks like Raymond, etc. Now, what is the margin for a particular stock? That you can go on your broker's website and check the same. Mind you, not all stocks are eligible for MTF. Only those stocks and equity ETF that fall under Group 1 security are eligible for MTF. You must be thinking everything seems simple, but this is when things get tricky. Since you have borrowed the money, whenever there is a drop in the stock, then it hurts your capital more than usual. Let me explain you with help of an example. Let's say we invested 1 lakh rupees where you have paid upfront margin of 25%, which is 25,000. Now there was a 10% fall, which means 1 lakh has come down to 90,000. 75,000 was paid by your broker, but in this case, your 25,000 has come down to 15,000. So instead of 10% fall, what you see is a 40% loss. If the stock continues to fall, then in that case, broker can ask you to add more funds to cover for that margin. And in case you fail to add more funds, in that case, broker can sell your stock to recover the money, and that selling can be at loss. Now comes the big question. Should you use MTF? Well, to answer that, you need to ask these 3 questions to yourself. Number 1, do you have the ability to monitor the trades daily? If not, then margin calls can lead to liquidation at bad prices. If you are investing for long term, then you might have to pay higher interest charges and your interest amount will pile up. And number 3, can I handle the risk of leverage? Well, if you are using MTF to trade larger quantities, then you need not do it because you are increasing your risk as well, which will harm your capital. So MTF isn't just free money, it's borrowed money. It can help to amplify your profits, but also your losses. So you need to trade wisely, otherwise it can wipe out your capital. I hope you like this video. See you in the next one. Till then, happy investing.